Hey everybody, in yesterday's video to kick off the fresh trading week, we talked about some levels in the major equity indices. I want to follow up on that and kind of give you my view here on a potential 6 to 9 month trading range that I think we could be in now. I laid out a similar case a few months ago. We extended it, we went above that trading range for a little bit, but not much, and we're right back into it now. So I just wanted to reiterate that trading range, and quite frankly, it's almost stupid simple, but I think it really helps from a risk management perspective, whether one is sort of operating more on the what I call bucket 2 trading or swing trading sort of timeframes, or even from a longer term perspective. So the S&P 500, I'm looking at the actual SPX here. We had that sort of extension or break above the 2000, and actually it's a little bit lower here, above the 2021 highs. And I think we could kind of draw two, I guess potentially two ranges, but I think the one that I'm more confident in with right now is something like this, where we may have seen the highs for the year. And again, I laid this out a few months ago. We did actually go above that high for the year by about 100 or so points, I believe. So, but we're right back into it, right? And so I think that range could be something like, again, the highs we saw, 5,660-ish, which was the highs in July. And I think we have the potential to see the low of that range to be just below 5,000. It could certainly go to 4,800. But again, that's kind of the range I'm looking for. So the lower we break in that range, the more I'd be wanting to buy risk assets, in this case equities. The more we get back to the upper end of that range, the more I would want to be selling or going short or doing bear call option spreads or that kind of thing. And again, down here, one could buy risk assets, or again do bull put option spreads if one wants to be selling options volatility as opposed to buying options volatility, which of course is a better thing to do, to sell options volatility when implied volatility is high, which tends to happen when you would get to the lower end of the range. So that's something I'm looking at. Now, what we're doing this week, and this is really cool, I invited my friend Daniel Sinek, and he's a PhD. I call him Einstein, because he really is he also sounds a bit like Einstein. I mean this very respectfully, of course. Again, he's a good friend of mine. But he's a wizard when it comes to using AI in modern ways of using, I guess looking at the market through the lens of what is required these days with AI trading, and looking for really smart support and resistance levels, be that on the daily charts and the weekly charts, or certainly intraday as well. Because believe it or not, the fact that we have 85% of trading happening algorithmically these days, automated, right, but done by computers, means that using a simple moving average for support and resistance is prehistoric. It just doesn't work. It may work sometimes, but it's not very reliable. And so he's figured out a way to take all this modern AI stuff and actually turn this into an AI support and resistance reading machine that works wonderfully well using our methodology. So I'm super excited I've been working with him now for a few weeks on kind of testing it and putting it through a test, so I can put my own holes in it, if you will. So make sure you join us this week on that discussion. It's super fascinating just how algos work and how we can use smart AI tools to find better support and resistance zones to give us more confidence to buy, sell, go long, use leverage, go short, whatever we want to do through the lens of trading and investing. You can find out more about that down below or on the next screen. Please bring a pen and a piece of paper as always. We'll see you there.